Budget 2026 is set to be presented at a transitional juncture with the Income Tax Act 1961 slated for repeal and the new Income Tax Act 2025 yet to be implemented as it comes into force April 1 this year. The new Income Tax Act 25 was introduced with one of its objectives as simplification of statutory language and removal of redundant provisions. While the new act has undergone structural simplification, several monetary limits and classifications, some dating back to 1961, have never been rationalized for inflation, economic growth, and changes in the urban realities. For instance, the tax-free meal allowance continues to be capped at 50 rupees per meal, which no longer reflects urban food cost and has effectively become obsolete. Similarly, for calculating HRA exemption, metro cities continue to mean four cities, that is Delhi, Mumbai, Kolkata and Chennai, as were originally introduced and never updated thereafter. Cities such as Bengaluru, Hyderabad and Pune, despite comparable cost of living, are still treated as non-metros. Tax-free gift limit of Rs 50,000 under Section 56 to 10 shows a threshold that has not moved since its introduction despite changes in income levels and social practices. And a similar case is with the case of interest exemption on savings account, which is 10,000 rupees under Section 80 TTA, which was introduced way back in 2012 and needs a revamp as the real money value has eroded. While the new income tax rules under the proposed act are yet to be notified, Budget 2026 can still act as a strategic inflection point to reflect on the need to reset and recalibrate some of these existing monetary limits as a part of the broader tax policy realignment. Employment generation remains a key policy objective for India, particularly in the context of its evolving labor market and demographic trends. Employer-focused incentives play an important role in encouraging formal hiring. Considering that Section 80JJAA already provides a well-tested income tax framework for incentivizing incremental employment, aligning the gross income threshold of up to Rs 1 lakh under the recent PM Viksit Bharat Rozgar scheme with Section 80JJAA, where formal jobs count for deduction if the new employee's salary is equal to or less than 25,000 rupees per month, a threshold which has remained unchanged for years and low relative to the current wages, could promote consistency and also enhance the employer participation in the formal hiring segment. Also, extending the deferral of income tax on ESOP exercise to all DPIT recognized startups, maybe with some sort of guardrails or reporting based risk controls, could further support talent retention and ease cash flow pressures on employees. An equally pressing reform requirement lies in the first level appeal disposal rate. A statutory time limit for disposal of appeals by the Commissioner of Income Tax Appeals would help deal with prolonged litigation cycle. Even with the extended hierarchical delegation to JC appeals, which was introduced few years back, the first level appeal backlog has not achieved significant disposals over past few years. Although India has concluded a historic number of transfer pricing APAs, its advanced ruling mechanism for foreign players with Indian business interests largely remains dysfunctional, undermining tax certainty for inbound investors. Other areas from corporate tax standpoint include the need for allowing ESOP expenditure over the vesting period, which would better reflect economic reality and accounting principles. A framework may be introduced to allow foreign tax credit at the withholding tax stage itself that would ensure that the tax deducted is closer to the actual tax liability, reducing the dependence on tax refunds which comes much later in the cycle. Similarly, unutilized FTC may either be allowed as a permitted write-off for tax purposes or allowed to be carried forward akin to business losses. From an international tax perspective, in light of the Supreme Court's decision in Nestle, MFN benefits under the tax treaties are now operable only upon notification by the CBDT. A structured, time-bound notification framework coupled with publicly accessible list of MFN cases would significantly improve predictability in treaty application and reinforce investors' confidence. As India approaches its position as the world's fourth largest economy, India Inc. looks to Budget 2026 for tax reforms that can provide sustained momentum to this growth trajectory. Thereafter, aligning the domestic tax framework with global best practices such as group taxation regimes, cross-entity loss set-offs within corporate groups, innovation incentives, and certainty-driven administration will be key to support India in its next phase of economic growth.